Hello and welcome again to another financial analysis video with myself, Moed Amin, and Ted Wayman. Today we're going to be looking at a very well-known gaming business, Nintendo. Now the goal for this show, before we go into the finances, the goal for this show, this is an educational show and it's to help you raise your business acumen. And one of the best ways to raise your business acumen is to help you with the language of business, which is finance. Those are not my words, those are Warren Buffett's words. So in this show, what we're going to be doing is helping you understand the financial statements of companies, and we do that by analyzing famous companies from around the world. Now, 98% of those companies are requests. We're going to come on to that in a moment. Quick note about Nintendo before we go into the financial statement. Founded in 1889, and they actually started out manufacturing and selling what's called Hanafuda cards. I think I'm pronouncing that correctly. Playing cards. These are Japanese playing cards. Before they moved into gaming consoles around in the 1960s, I think they developed the first one in 1977. Don't quote me on that. But they are famous for the characters of Donkey Kong and Mario Brothers. And what's interesting is that the Nintendo Switch, which is their latest console, in their last annual statement, they actually sold the most consoles over any other console, right? So when you look at PlayStation 2, 3, etc., all the other consoles out there, they have sold more Nintendo Switch than any other consoles have sold, and they've just broken that record. So that was a really interesting thing to observe. And we're going to look at the finances in a moment. Quick thing to understand about the company. Now, in May, they announced a stock split of 10-1. Right, so if you have, if you have a share of a company, you will get 9 additional shares. Now, the reason why is because I think the shareholders were talking about improving the governance of the business. Effectively, what that means is it lowers the threshold ceiling for you to be able to invest in a company like this. Now, according to the FT as well, what was interesting is that if someone wanted to invest in Nintendo, they had a threshold of they had to buy 100 shares in order to then buy into Nintendo. So I thought that was quite interesting. According to the Financial Times, that was the case with them. So with that 10-1 stock split, theoretically, it makes it a lot easier. Now we're going to go into the share price in more detail towards the end of the video. So stick around for that, because that's important to view in context with the financial statements. Now, if you'd invested, and what I was able to find was, I think they floated in 1977, but I could only find information from 1996. Now, if you'd invested in 1996, you'd be sitting on an increase of about 453%, which is not bad. If you invested 5 years ago, you'd be sitting on an increase of 25%. If you invested a year ago, it's an increase of 20%. So not the kinds of decline that we've been seeing with a lot of other companies this year, but still not as high a growth as probably what's been happening. So they have seen some dips there. So let's dive into it. Oh, actually, one thing I forgot to mention. This company was a request from one of our viewers. So about 98% of the companies that we analyze are requests from viewers, and you can do the same. And Ted will talk about how you can do that in a moment. But this was a request from 2 people. Well, actually the same person, but so interested in this company that they asked for this twice. So Cicero, here is your video. I hope you find it very useful. Do please leave any notes or comments from what you've observed about the video. So without further ado, let's go straight into it. Ted, if we can share with our viewers what we've analyzed about this company and help them better analyze similar companies to Nintendo and even their future financial statements as well.
Absolutely. So good to see you, Moed, and welcome back to all of our subscribers. Welcome to our viewers. If you are new to the channel and you have yet to subscribe, please do click the subscribe button. Don't forget to like and share the video. So do click on the like button, give us a thumbs up, and share it with your colleagues. And also leave your feedback. Tell us what you think of it. Tell us where we get it wrong. I'm not going to say that I get everything right. Obviously, if you are pointing out my numerous mistakes and shortcomings, please always be polite. you will see on your screen annual report 2022. So this is for the up to the 31st of March 2022 for Nintendo. Lots of information about the business. We are going to shoot all the way down through to the numbers. Here are the numbers. So we're going to start off with the income statement. If I can find the income statement, here it is. So here's the income statement. So we are dealing in millions of yen. So this is kind of this is last year is on the left, and then this year is on the right. And you'll notice that we're in millions of yen. So total turnover is 1.7 trillion yen. And just so that we understand what that kind of means, if you don't think in terms of yen, certainly I don't, that's about 14,000 million, so about $14 billion. So top line is their sales $14 billion, but we're going to talk in terms of yen. So what are they selling? They're selling games and consoles, and they are selling them at about a 56% gross margin. So 55% last year, 56% this year. So pretty good. And then they've got the costs of running the business here, leaving them with an operating profit of 600 billion yen, which is basically a 35% operating margin. Once we've taken into account all of the other costs, and they're listed for you there, and I'll just highlight a few of them. There's a bit of Forex exchange going on there. Little bit of interest expense, suggesting that they've got, very little debt. They are making a bottom line profit of, we can just scroll down a little bit. So bottom line profit, 478 billion yen, about $3.9 billion. Okay, that's a 28% net margin, 27% in the previous year. So very, very profitable, these guys. So very, very profitable. Looking at the balance sheet is actually looking pretty strong. Oops, I'm going the wrong way. So here's their balance sheet. Assets. So they have the non-current assets, the things they need to run the business, which is kind of everything down here. So the non-current assets, things that they need to run the business, that's this bit here. So all of this, so they've got, a lot of investment securities. Now, investment securities, that's just basically cash. So they just parked cash there. So when we see that, that means that these guys, they have a lot of cash, and it's just sitting on the balance sheet, effectively doing very little. Little bit of property, plant and equipment and buildings and shares. They've got some land. If you're making games, you don't really need land. So again, there's an element of investment that's going on there. They do need their software development. That's this line here. And then investment securities, as I said, is basically cash. So quite a lot of cash. And then in terms of the current assets, again, even more cash up here. These notes, they've got some more securities. So these securities, this is also cash. So when we're starting to look at this balance sheet, it's basically stuffed full of cash. There's no debt there, or nothing really to write home about. Well, we'll look at the liabilities in a minute. Little bit of inventories of the consoles, for example. So really very much a current asset business rather than a non-current asset business. And what they do have, they don't really need a huge amount in terms of the non-current assets. On their liability side, so they do have a little bit of notes and accounts payable, for example. So that's probably where they're paying their interest, but really very, very small. So they've got 540 billion compared with 2.1 trillion of current assets. So liquidity really isn't an issue, and of course that 2.1 trillion of current assets doesn't include the long-term marketable securities, effectively their investments. So very, very strong. And then they're sitting on all these retained earnings. So that's driving the funding of the business in terms of equity, is this retained earnings. A little bit of treasury shares, just to remind ourselves that those are kind of shares in Nintendo. So these are another way of a company returning money to the shareholders rather than paying out a dividend. They have been buying back their own shares. And so the total net assets, 2 trillion yen, which is effectively the equity in the business. So looking pretty strong there. have a look at the cash flow. Well, here we've got the shareholders' equity. We see in the shareholders' equity, we'll just sort of stop off and have a look here. So this is the previous year. That there's the profit coming in, and they are paying a substantial amount in dividends. So if you are a shareholder, you are getting a decent amount of income from these guys. And if we look at the following year, again, there's the profit for the year, and once again the dividend surplus, and also this is just basic. It's not that's the share buyback over here. So they're actually physically buying 95 shares. Then they can either sit on those shares, or they can effectively cancel them. And so that's that transaction going on here. So really, we're interested in kind of the share buyback 95 billion and the dividend 240 billion. So lots being returned back to the shareholders. And then finally, here is the cash flow. And in terms of the cash flow, the cash, in terms of their cash generation, here's the cash generation going on. So 290 billion. Interesting enough, less than half of the previous year. So even though their profitability is very similar, we might want to just see, why is that? Well, it looks to me like, there's a big sort of ramp up in terms of inventory. As Moeed was saying, very successful in terms of their sales. So they're anticipating that, and they're just spending a lot of money building up their inventory. And there's also a little bit of an increase in tax paid compared with the previous year. So no real alarm bells there. Pretty strong cash flow coming through from this business. Very small amount of depreciation there. You'll notice that's obviously because they're very small in terms of their investment base, their capital, their capex, so to speak. The investing activities, very, very distorted picture here, because the investing activities for these guys is all about buying and selling investment securities. So this is effectively, they've got cash, they put it on deposit, they need some cash, they take it off deposit. That's their pure investment. That's the capex going on, and then we've got some additional stuff going in and out of time deposits. So these four numbers that I circled, this is really just movement of cash. It's not really investing. It's not investing in the future of the business. The investing number is really here, but they have to classify these short-term and long-term investment securities as investing rather than as movements in cash because of IFRS limitations. And then down the bottom, purchase of treasury shares and the dividends paid. So I highlighted that in the movement in equity. So here we have, they are actually buying back their shares, and they are paying out dividends. So if you are a shareholder, again, they're pushing capital growth in their shares, and they are providing a pretty reasonable income, and still sitting on $1 trillion of cash at the end of the year. So these guys really are generating lots and lots of cash. So let's have a look at their performance in terms of the share price. So as we would probably expect, sort of a pretty relentless rise. Quite interesting by Moeed, you and I were kind of bemoaning kind of Google share prices, that there's no PE ratio, no dividend yield, which is a little bit odd, because these guys are definitely generating income, and they are also definitely generating they're paying a dividend, so there should be a dividend yield. So 7.9 trillion, that's their market cap. So I reckon by my calculation, that's about 16.5 times earnings. So a PE ratio of 16.5, which is, it's not cheap, but it's not crazy expensive. It's not silly kind of Tesla multiples, but it's not overly cheap. That's about a 6% yield. Their dividend represents about a 3% yield. If you include the dividend and the share buybacks, then you are looking at a yield of, let me just work it out, hold on a sec. So probably up to about a little bit more than that, so about 4%, for example. So yeah, so the yield with the if you include the share buybacks as a sort of a way of returning money to the shareholders, then you're looking at about a 4.3% yield. The balance sheet, their balance sheet is 2 trillion. They're valued at 7.9 trillion. So you've got a difference there of about 5.9 trillion. And that's what I call kind of the inherent goodwill. So that's a representation of the value of the brand, etc., etc. Now, I know Nintendo does have does have some challenges. They like to produce their games. You can't play their games on anything else. You need to buy the hardware in order to be able to use the software, for example. They've been very successful at it in the past, consistently successful at it. But of course, you know, past performance is no guarantee of future performance, and you know, whether they can continue to sell the consoles and people will buy those consoles in order to be able to play those Nintendo games. You know, we have no idea, especially with things like, you know, metaverse coming along and all that kind of stuff, etc., etc. So, you know, these guys, you know, they look to me as if they are quite expensive. Let's put it like that. They look quite expensive for what they are, but you know, so I think they're kind of probably at the riskier end of your play, if they can, you know, if they can carry on replicating the successes of the past. No, there's no reason why they shouldn't be able to, because they proved pretty adept at it. But you know, we need to realize that, you know, they live in a quite a fickle and quite a fast changing market, and it's very easy to kind of, you know, find yourself in the wilderness with the kind of, you know, the games that they're producing. So there you go, Moeed. That's my take on Nintendo. You know, very profitable, strong cash flow, you know, really solid balance sheet, you know, no problems in terms of the financials. It's not cheap. I wouldn't say it's expensive, but it certainly isn't cheap. And if you're buying this company, then you are really buying into their ability to carry on weaving that magic that they've been doing so effectively in the past.
Great. So there you have it. Don't forget to like, share, subscribe, and if you have a company that you're really interested in, and whether that's because you're selling to them, that's the area that I'm involved with, or if you're interested in investing in them, or even if you actually have an interview with them and you need to brush up on your knowledge about that company, really sound smart for that interview, then do leave a note in the comment section, and also give us some context, give us the story behind why you're interested in that company. The more interesting that story is, naturally, the more likely you're going to be prioritized on that request list. So do leave those notes in the comment section. Until the next video, thank you, Ted. Thank you, everyone.
No problems, Moeed. Good to see you. Catch you later.